Good morning, ladies and gentlemen. Well, we are about to have one of the biggest liquidity drains we've had for a very long time, if in history probably. So there's a $500 billion worth of bills to be issued this month alone. And really the interesting thing is, where is it going to come from? So, without further ado, let's have a look at what bonds are likely to do and therefore the implications for everything else. As we all know, the RRP rate that the Fed pays out on the reverse repo is 5.05% at the moment. If they were to hike in June, that would probably go up to, let's say, 5.25, or maybe 5.30. So really, the big question is, who is going to buy this $500 billion? And the answer is really simple. It depends on the rate of the bills. If bills trade below RRP, the only people who are going to buy them are going to be banks, or if not the banks, then the private sector by taking money out of banks. As we know, the situation with bank reserves is quite ample at the moment, so it shouldn't be an enormous problem. But we have a situation in which banking liquidity is decreasing. The regional banks are having their problems, and they have to basically downsize their balance sheet. And that could be a significant problem going forward in that environment if all the money comes out of the banks as opposed to coming out of the money market funds. I doubt very much if money market funds are going to invest in term bills if they can get a very similar rate in overnight repos. So that is going to be the key over the course of the next 3-4 weeks, to look at the difference, the differential between 1 month, 3 month, and 1 year bills compared to the RRP rate. Because let's face it, there's very, very little likelihood that the Fed is going to cut rates at any time soon. In fact, they're still in hiking mode. And it's quite possible that they hike once June, July, and then again once in a later period before the end of 2023. That is going to pose a problem for the money to come out of the RRP. You know, we have $2 trillion sitting there. Why not give it to the Fed at, let's say, in July, and keep on giving it to them at 5.25, 5.30, rather than buying 1 year bills at 5.25? The only reason why you would go out on the term curve in bills is because you expect a rapid fall in rates at some future stage before this 1 year bill expires. You know, everything is possible and everything is a question of degree, but I would argue that the likelihood of that happening over the course of the next few weeks is very low. And therefore, I feel that these term bills, whether it be the 1 month, the 3 month, or the 1 year, needs to go higher in order to attract the money market funds from from putting it into RRP and going into term. Certainly, if I saw over 550 on 1 year bills, I would be tempted to buy those instead of keeping it on a floating rate like I do at the moment, or by giving it to a money market fund that invests in the RRP. So I personally would be taking my money out of money markets and putting it into term bills, but I would want some give up compared to what the RRP rate is where money market funds invest. And I would want at least 25, 30, 40 basis points of give up. So I would want new highs in the 1 year bill. That's what I would expect is going to happen over the course of the next several weeks. After the Friday non-farm payrolls, all we have before the interest rate decision by the FOMC is the CPI the day before. So we've really run out of economic data for the Fed to decide that, yes, we should skip. I can understand that they don't want to raise in both June and July, but I think they're going to have a very tough time if CPI is in line or higher than expected to decide to skip June and go to July. It really would smack of desperation, and I don't think the long end of the curve would like that. I think in that case you would have a definite steepening in the curve. At the moment we're still getting, however slight, a bear flattening, pardon me. What does a bear flattening imply? It implies that all rates are going up, it's just that the shortest end is going up slightly more than the longer end in yield. Now, is that really happening? Well, yes or no, yes and no. I keep on telling you that the curve should bear flatten. And it is, in a way, because let's face it, over the course of the past 5 days, it has not come down, but also it has not really gone up in yield very much, and this is the twos, obviously. I still expect, and it makes mathematical sense, that the twos should be the weakest on tenure on the curve. Simply because if I expect the RRP to go from 505 to 530 in 2 weeks' time, and then I expect the term bills, the 1 month, 3 month, 1 year bills, to go eventually above RRP because they have to attract the money market funds to invest in those rather than in the RRP, then I have to expect that that is going to have a significant drag on the 2 year. And, you know, it really would not surprise me to see the 2 year go all the way up to 475. I don't think that we're going to see new highs in the 2 year. But I do expect some movement higher because otherwise we're pricing in so many cuts at the back end in sort of beginning from 2024 that it's completely unrealistic. If you do the forwards and try to work out if the 1 year bill is at, I don't know, even 430, 440, for this 2 year to remain where it is, you are pricing in something like 200 basis points worth of cuts coming out the second half of 2024 on. It's possible, but it's becoming extreme. And therefore my preferred direction of travel for everything, for every tenure, is still higher to at least 475 in the 2 year. If we look at the 5 year, you know, this kind of area around 405, 406, you know, 403, something like that is my preferred direction of travel. In the 10s, around the 390 area. And in the 30s, we've probably seen it, but still a return to these levels and basically doing what we've been doing here, going up and down, around the 4% area. with a slight tendency for the yield curve to bear flatten. If we look at the 2s, 5s, they're still, bear flattening. What did they do last week? Very little, but this is where we closed the week before, and we're still a little bit higher. So that is still going, and it makes sense that it should. It's not going anywhere near as fast or as far as I'm expecting, which tells me that the market is still willing to price in a lot of cuts in 2024 and 2025. Well, why would they price in these cuts? The only thing that is saying is that they're still expecting recession to hit at some time. Well, either the bond market is very wrong or the equity market is very wrong. I mean, at this stage, you can't really say that anything a third outcome is possible. So let's have a look at the 2s, 10s. Yes, that is still bear flattening. These are the 5 days that we traded last week. But as you can see, the difference between where we closed last week and where we are now is barely 4 or 5 basis points. And we still even haven't closed the gap up to 90. I expect to see this gap closed. But just how slowly this is doing it still tells me that people are very much prepared to price in cuts at the back end, and therefore that people are very much still expecting recession. 2s, 30s is probably the one that has the most, although it's the one that's actually moved the least in the past week. It's moved like 2 basis points. But you can see where the gap is, and at some stage I expect that to be filled. This kind of level around 88 basis points is very significant. You can see this previous high. And I still expect, as people accept that the Fed is going to hike at least once more this year, and I would expect 2 hikes this year, and have the RRP north of 5.5%, I expect these gaps to be filled via a bear flattener. It's the only thing that keeps on making sense to me. One more comment on bonds. Some of you might say, okay, Nick, they've got $500 billion to fund at the short end, and they have a very heavy issuance calendar of coupons for June and July, which is preset. Now, normally the Treasury hates or does not like, let's put it that way, increasing the calendar of the term auctions which have been already announced. So basically, if they said we're going to issue, I don't know, 30 billion worth of 5s, as an example, they hate doubling that to 60 billion and decreasing from the bill side. So they, basically what I'm saying is that they are unlikely to do that because the market has to have time to price in the amount of term paper because of its duration, which is much higher naturally than bills, and therefore the market needs time to adjust and to find out where the demand is. It's not a simple process like selling bills. Therefore, the question then becomes, does it make sense for the Fed, let's say the Fed wants to be in collusion with the Treasury, which I think is actually unlikely. But let's assume that, yes, the US government wants to massage somehow the best they can get this refunding off as a rate. Does it make sense for them to skip June and keep the RRP at 505 for political reasons, right? Not for fundamental reasons, because for fundamental reasons, having just seen what the NFP was, and assuming that we get an inline or stronger than inline CPI, which shows the stickiness that CPI has shown all year, does it make sense for the Fed to skip in June? And I will say no, because then, yes, the bills will remain in line and will remain lower, but the yield curve is going to have a very bad time, and it's actually going to steepen. You will see the yield curve fall to these levels. People will buy the 3-month bills, the 1 year, and therefore actually readjust the 2-year downwards. But I doubt very much that the 10-year would like it. I doubt very much that long bonds would like it. So I think that they would lose far more on the 5s, 10s, and 30s they're going to issue this month than they will make on the tiny amounts that they will, save on the bills. So I think that that would be very short-sighted. It would give actually the long end very big problems, and the yield curve would actually steepen quite a bit. So that is another danger that we have, and probably the reason why it's flattening so slowly, because people are actually afraid that given all this bad data, i.e. strong data on the economy and on inflation, etc., the Fed might, for political reasons, skip. I think that that is something that is overblown and something that is unlikely, because if they do the maths, they're going to lose far more on the term premium than they are going to save on the bills, and therefore it would send a horrific message to the market. First thing I would do if I heard that the Fed was skipping, or not even skipping but stopping, I would sell long bonds. I would get out of nominal bonds altogether. I would go into inflation protected. I would go into gold even. I would go into equities. I would go into anything but long bonds. And that is, I don't think, what they want. Another way to pictorially look at this argument that I've just given you is that five-year forward inflation expectation rates at the beginning of the year, on the first day of the year, here it is, 223. What were they on Friday? 223, i.e. zero movement in the inflation expectation rate. How have they achieved that? Well, they achieved that by tightening, right? So the tightening is keeping the inflation expectations anchored. If they now were to stop the tightening when the numbers don't, when the data on the real economy don't warrant it, the danger is that this would rise. Same thing for the 10-year break-evens. If we have a look at where they were on January the 3rd, 226 to 222 on the next day, so let's call it 225. Where are we now? 218. Okay, so we are 5-6 basis points lower than we were at the beginning of the year. That would be jeopardized by the Fed not doing its job. Now, why would they risk that? To me, that would be so stupid, so short-sighted. What, to save 25 basis points in RRP on a 1-month bill? That is just silly. So I think that argument that they're going to skip for that reason is not a good one. If they're going to skip, it has to be because the CPI is lower than the speed of the path that they have set out. Otherwise, it really doesn't make any sense, because why endanger this? This is so beautiful as far as the Fed is concerned. They're keeping inflation expectations anchored quite close to their longer term target of 2%, and to do anything but continue to tighten to keep this rate where it is would be, I think, very short-sighted. The German curve is doing very little, and it's traded in a very, very tight defined range, 220, 250 in the 10 years, very much the same in the 2-year. It's basically trading around 268 to 3%. That is your range. And the 5-year is basically trading between 212 and just over 250. Those are the ranges which I don't think are going to get broken anytime soon, because the ECB has said that they're on a journey. They're slowly increasing the rates. So every time it dips, I think it's definitely, the danger is still towards the higher levels of 285 in 5s and again 341 in the 2s. But to me, there's far more stability. There's far more certainty in Europe, and that is at the moment contributing to the moves that we're seeing in the crosses, which are favoring Europe, and we're going up to these levels. I very much doubt that 2s can cross through 180, and that is what's limiting the US to the upside. 5s around here, 159, 160, and 10s here around the 142. Certainly if I ever see 152 again, I'm going to go heavy to the downside. But we're in this period of consolidation between, let's call it 123 and 142. That is the kind of area that it will continue to trade, and that's why I don't think that 10s are going to make new highs in the US, because I don't think they're going to make new highs in Germany. I don't think this spread is going to balloon outwards, simply because we're in the same situation in both. We have the ECB, which says it's on a journey to tighten some more, and another 50 is expected there. And we are on another in a journey by the Fed, and I think another 50 will happen this year in 225s, whether it's June, July, I don't know, October, or whatever it happens to be. To me is less important. But what I really don't think is that either central bank wants to jeopardize its credibility, but doing too little too late. It's just silly. The dollar didn't do much last week. Basically, it closed almost exactly where it opened. And the interest rate differentials, as I just showed you, are actually slightly supportive of the dollar. And therefore, I think the odds of the dollar going through 103 on the downside are actually very, very slight. My expectations would rather be for retests of the highs and probably slightly surpass the highs, but really not going much past 105 on the Dixie. That's because, as I just showed you, those differentials, well, on the 10s, we could be going up towards that 145 area, i.e. make new highs, which would push the dollar back up to this range, set some stops off towards 105. But then I expect the longer term differentials to start coming in again. And therefore, I think the dollar is going to be in a tight range between 105 and small change and 103 to the downside. I really don't think that the downside is very likely at all. I think it's much more likely to go and trade towards 105 and slightly higher than it is to break 103. That is all I have to say about it. I think there's very little chance of the dollar being weak next week. In terms of Euro USD, what does that imply? Well, I see, I think we've actually reached the top, and I think we are unlikely to even see 108. But certainly my top of the range would be 108, and my bottom of the range would be somewhere like here, just around the 106 area. Maybe, just set off a few stops below 106 and then come back. So anywhere between 106 and 108 is my trading range, with the favored downside that maybe takes out 106 for a few moments and then comes back. Gold, I don't like, simply because I think rates, as I showed you, are still my favored side is higher yields for everything. I still think the curve, as I said earlier, should flatten, but it's not really flattening. If you looked at the price action on Friday, yes, the twos led, but by the end of the day, the 30s had basically caught up with the twos. The net movement wasn't that large in terms of flattening. It was more a move for higher rates overall throughout the 10 years. Now, if the moves continue for higher rates, as I think they should, it makes fundamental sense that they should, and also that the differentials between the US and Germany are slightly in an uptrend, and therefore the DXY is still likely to trade higher, I can't believe that gold is going to do anything but test the downside. Now, it keeps on holding, it around this 1959 area, which it should, right? It's a very important level, but I still am of the opinion that it will at some stage break it, make new lows, and certainly, if nothing else, fill this gap down to 1903. But my favored area is still 1881, and that is where I intend to cover shorts. Now, let's talk about gold slightly longer term in context of what I said earlier about the Fed not hiking. If the market perceives that the Fed is abandoning somehow its fight against inflation, which I think would be suicidal for the Fed, and I don't think for a moment they're going to do it, then gold becomes particularly attractive, because in the likelihood or the odds of inflation expectations becoming unhinged, i.e. that chart that I showed you earlier about the fives and the tens, inflation expectations, risks becoming the anchor to the upside, something that they have managed to control extremely well this year by doing, by tightening. Now, gold at the moment has to price in a very high likelihood that the Fed will tighten, and therefore it should remain weak. But should the Fed not tighten, I think gold goes back up towards the 2045 area and probably at some stage breaks it, and breaks it violently. So a lot will ride on what the Fed does and how the Fed explains what it's done. For the time being, for the next week, I still think the downside is the favored side. But after that, and should the Fed do nothing, I think gold becomes a very, very interesting asset, as do inflation protected, bonds, but not nominal bonds, and equities also become very, very interesting too. We have OPEC today. We will see what they decide. But it's a market that keeps on, testing the downside and bouncing off the 200-week moving average. It's still in a bear market. Nothing good happens below the 200-day moving average. I still expect this area here to be an interesting area to buy. So just below 60 and between 64 and 60. If we have a look at what that means for DBC, it still means what I said, this 2175 area. It keeps on testing lower and not maintaining it. But this 2175 down to 2053 area, I think is going to be very interesting for long-term holds. And gold against DBC, it's not breaking out, and therefore I would expect it to test at least 776 next week. And that basically ties in with oil not doing very much and gold testing lower. I still don't like gold. I still think that next week it has to really move lower as opposed to higher. Gold against copper is breaking down slightly, which encourages my view that gold will be weak next week. And unfortunately in copper, I'm still waiting for my 3.5 level to trade. There's a chance I'm keeping my bid there. I like copper very much longer term. Everything I read about the stocks and how much copper is going to be needed over the next decade encourages me in the belief that 3.5, if seen, is a decent level for a multi-year hold. So, still there, still looking at, this chart to trade lower, gold against copper, validating the higher interest rates in bonds, higher yields. We will see if it happens, but I see absolutely no reason to believe that rates are still not heading higher, and that commodities at some stage will become a very good buy, but only once we've seen the levels that I've mentioned in DBC, oil, and copper. Before we look at the equity charts per se, let's have a look at some of the risk indicators. This is SPY over SHY, so basically the short end of the bonds. And you can see that we are now at a very important resistance level. If we look at SPY over IEF, we can see that we are actually breaking out and we are trading higher than the previous highest level. If we look at SPY TLT, it's even more obvious that SPY TLT is going higher, which basically means that that equities are favored over bonds. I don't think there's very much more to be said. This chart would not look like this if we were in risk off. Okay, so we are not in risk off. We haven't been in risk off all year. Apart from this very brief period, which was the banking crisis. And then after that, we've just been basically going up. And it should have been obvious to everyone that we were not going to go down in SPX or in NDX or anything else. So I'm just showing you these risk indicators, and this is now ITOT over government, so the totality of the stock market over the totality of the bond market, irrespective of duration and stuff like that. So this is, I don't know how many thousands of stocks, but this is the broadest stock market measure. As you can see, we continue to break out. Are we overbought? Absolutely. Can we come back? Yes. Fill this gap? No problem at all. And that's what I'll be arguing a bit later on. But you can see the direction of travel. What the market is actually saying, at a guess, is that equities are going to yield you just about as much as the bond market is going to, And also they are going to give you A, the possibility of growth, but B, better inflation protection than nominal bonds. I keep on thinking that nominal bonds are not a buy yet. I just can't see why you would but want to hold a negative yield curve with cuts priced in. To me, that is just very bad risk reward, which steers money towards equities. I think it's as simple as that. Will there be, sharp retracements? Yes. But I think the direction of travel for the time being, until things change, or until a recession hits, or we see any kind of clues that a recession is about to hit, the path of least resistance for all these bond over equity indicators is still up. Let's have a look at a clean chart with my support resistance levels. And as you can see, we have reached the first objective that I gave you last week, 42.55, and exceeded it. Right, so what happens now? As you can see from the past, this area tends to be very volatile. Here it failed miserably, but every other time it reached 43.84, 43.85. Did it take a long time? Sometimes. Did it take a day? Sometimes. But these 43.85 to me in SPX is the next sizable resistance. Here there is nothing left really because we filled this gap. Could this be the resistance? 43.12, i.e. another 30 ticks from where we closed on Friday? Absolutely. And I think that is probably going to be the first resistance. 43, let's call it 43.08, whatever. But is it likely to be the ultimate resistance? I'm not so sure. I think this kind of level, 43.85, is more probable. But let's have a look at what is actually happening under the surface of the market to give us these levels, and therefore we can estimate the likelihood and how we're going to get there. Now, when we get there, I have no compunction in saying that we will be vastly overbought. And every time that we get to these vastly overbought levels above these ratios, we have a very, very steep decline again. Why that would be, I have no idea. What will cause it, but I have absolutely no doubt that it will happen. If you'd just been a monkey and sold when it exceeded 1.2867 as a ratio, you would have made money 9 times out of 10 and much more than you would have lost had you had a sensible stop loss. So I intend to do it again. Not from this level though. Let's have a look at some weekly charts. Now this is the Qs. I still think it's likely that we trade this 363 to 365 area. Let's have a look at something else, XLK. XLK did a weekly doji outside of the Bollinger Bands. It's something that it did there, right? And it still managed to go higher, but eventually it took many weeks. These are weekly bars, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 weeks of going basically nowhere outside that area. And that wouldn't really surprise me if now we just basically bounce around with this 161 area as 161.80 as support in XLK. Now, XLK is slightly different from the Qs, of course, and that is why I think the Qs can reach 365, and therefore why I'm not immediately bearish of NQ, of the Nasdaq. But the fact that XLK has done what it has done, and it's it's a weekly doji outside of the Bollinger Bands, tells me that XLK is going to struggle, and therefore NQ is not going to be parabolic anymore. And therefore the Qs aren't going to be parabolic. If we have, where are we, 355 to 364, what is that? 2.5%, 3%. So that is the kind of thing that you're looking on the upside. And that tells me that it's, if SPX is to reach this level, let's say 100 higher than where we are, that is going to be an exhaustion in the Qs as well as XLK. That will go into the NASDAQ, and that is it. So we've got to have a look at the other indices to see if they can support a move higher as well. Looking at at NASDAQ by itself, NDX, I still see absolutely no reason why we don't fill this gap that we have up to 14,820. That doji I showed you in XLK is no reason not to expect a couple of percent more in terms of momentum for the NASDAQ, because the Qs can go up, XLK buggers around. So to me, this kind of 15,000 area, just below 15,000, gets triggered, probably goes slightly above 15,000, get everybody to buy it, and then you can have a decent kind of retracement. As far as support is concerned, I think even these levels, around 14,200, are very unlikely to be broken in the short term before we have touched the 15,000 area. It's just, there is too much talk and too many people who still want to get in. It's just not extreme enough in terms of price action to think that you can sell it. I certainly wouldn't sell it, not until it's done a lot more in terms of parabolic movements. So if I think that we're reaching the last couple of percent that the NASDAQ is going to help, then if we for SPX to exceed the ultimate target that we are looking for, which is that area around 85, the Dow really has to start performing, and to me it's unlikely. Again, this 341.47 on DIA is the highest weekly close. We need a weekly close to exceed that and exceed these highs, and then you're still bumping into the Bollinger Bands, and the Dow really doesn't like to stay above the weekly Bollinger Bands for very long. In fact, if you have a look at this chart, it hardly ever does, and when it does, it retraces straight back. So what I'm saying is that the market is unlikely to exceed the levels that we are looking for, and that at those levels that of the SPX chart that I showed you, the risk reward becomes to the downside. But I don't think it's going to be next week, and I don't think it's going to be from the levels we've seen. I still think all these dips short-term dips that we see in SPX are going to get bought all the way into the Fed, unless we see some kind of a melt up, and that level in ES around the 85 level, 43.85, which is another 100 ticks, which is 2.5%. It's possible, but anything around there, I think buying put spreads in the short term is going to be very rewarding, and I think there is for sure where the bull trap is. A word about Japan, my favored long. I just don't see this stopping, simply because I know how the Japanese markets trade. I think the Bollinger Bands mean nothing until they mean something. I think there's so much pent-up demand here from abroad, and the Japanese have already sold, and I don't think they have anything left to sell, not very much, that this just has to continue. And if this continues, the likelihood of SPX having a tremendously bad day is very slight. The spread keeps on going out, that's for sure, but it's it. I will show you on a short-term Nikkei chart how well it trades short-term and why you should set up this chart and trade it. And this is the 10-minute chart that I use for the Nikkei NKD. And I've just basically set up an algo to buy it every time it reaches the moving averages when they're positively sloped with a sensible stop loss. It makes a lot more money than it loses, put it this way, because we are in trend, and in trend you want to use the moving averages. Now these are my very important levels for next week, 31,580 to 31,440. If the market can't break below those levels, and I'll be buying it every time now that it touches the this moving average, you buy a little at this one, you double, triple up on that one, and basically trade it as an average. The likelihood of SPX being able to go down if we can't break in the Nikkei, to me, is almost zero. I think all these markets are at the moment in a re-rating phase against bonds, and therefore the likelihood of any of these equity markets having horrendously bad days are very low. So I'm literally a buyer every time it breaks down towards the moving averages. I think Nikkei leads. I think the US is second, and I think Europe is a distant third. With that, I've updated all the levels. I still think that the path of least resistance is for higher bonds. I still think the yield curve should be flattening, but it's not really. So we shall see, but I think that the odds of lower rates next week is fairly low. And I think as a result, I think gold is definitely going down and will break 1959. Let's see what happens. I've also marked this for you, which is an interview. I mean, not an interview, it's basically a monologue from Fed Guy. It will tell you, it will explain to you in much more detail about how the TGA is getting refilled. And I think the key point is around 850 approximately. That makes a lot of sense, and it's exactly what I told you. But he just explains it more fully because he goes on a full 15 minutes about it, and I did 3 minutes on it. So he's got a lot more detail. And my view and his are basically identical. But I think that you should listen to this interview just for your own, education, and so that you understand in more detail the way that my mind works. Thank you very much indeed, and tweet you tomorrow.